Silver jumped $87.20 today. Gold climbed back to $4,929. Both metals are reversing violently upward after the worst crash in modern history, a 41% wipeout in just 72 hours. Complete liquidation, forced selling across every exchange on Earth. And while that was happening, someone was quietly accumulating the exact same metal at prices 20% higher than what Western traders were dumping it for. That person knew something, and what I'm about to show you will change how you see every headline, every price move, and every government statement for the rest of this year. I break down the financial power moves happening behind closed doors while mainstream media feeds you surface-level narratives. If you are new, subscribe immediately because this analysis does not exist anywhere else. And if this connects dots you have been missing, hit that like button right now. It tells the algorithm to push this to more people who need to see what is really happening. Here's what nobody's telling you. 2 weeks ago, silver hit $121, an all-time record. Gold touched $5,295, historic highs. The rally was driven by central bank accumulation, currency debasement fears, and industrial demand surging from solar panels to electric vehicles. Then everything reversed. January 30th. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is known for hawkish policy, tighter monetary conditions, higher interest rates. Precious metals react negatively to that combination every single time. The dollar strengthened simultaneously. That dual pressure triggered the collapse. But what happened next was not a normal correction. It was systematic extermination of long positions. Gold dropped $200 in 10 minutes. Not hours. 10 minutes. From $5,595 to $5,395. Gone while you were pouring coffee, silver became the earthquake. Asian markets opened first. Chinese speculators who had been driving prices higher every single night for weeks suddenly flipped. Profit-taking turned into panic. Selling fed more selling. Every tick lower triggered margin calls across thousands of accounts. Every margin call forced more liquidation. Every wave of forced selling triggered the next cascade. It was a chain reaction, self-reinforcing, unstoppable. Algorithms were selling into other algorithms. Human traders could not even process the speed. One fund manager said he physically felt nauseous watching his screen. Another with 20 years in commodities said he had never witnessed anything moving that fast in his entire career. By the time London opened, the destruction was already catastrophic. Friday, January 30th. Silver collapsed 37%, from $121 down toward $75, the largest single-day crash in 46 years, not since 1980. Gold plunged 9% in a session. Traders everywhere used one word, bloodbath. But Friday was not the floor. What happened over the weekend made everything exponentially worse. Someone poured gasoline directly onto an already raging fire. The CME group raised margin requirements on silver from 11% to 15%. Let me translate what that actually means in practice. Imagine you control $100,000 of silver with $11,000 down. That is your margin, your deposit. Saturday night, the exchange calls and demands $15,000 instead. You have until Monday morning to produce $4,000 more dollars, or they liquidate your entire position immediately at whatever price exists at that exact moment. Multiply that scenario across tens of thousands of traders globally. Nobody had extra cash sitting idle after a 37% Friday massacre. Everyone was already bleeding. Now exchanges were demanding more money on a weekend when banks were closed. Panic went vertical. Monday morning arrived like a freight train nobody could stop. Traders had no choice. Liquidate or be liquidated. Forced selling opened the floodgates wider. Silver didn't just fall, it disintegrated. From the Friday close around $75, it plunged another brutal leg downward. The metal that had touched $121 just days earlier was now trading in the 70s, then 60s. The total damage from peak to trough. Silver lost over 40% of its value in 72 hours. Gold shed nearly 15%. Trillions of dollars in paper value vanished into thin air. But here is where every other video about this crash stops. They explain what happened. They tell you why. They warn you to be careful. Then they move on to the next topic. I'm about to show you 3 pieces of evidence that completely flip the entire narrative. 3 data points that nobody else is connecting. And the first one made me physically stop and recheck the numbers 3 separate times, because I could not believe what I was seeing. While silver was collapsing in the West, while every exchange was in full liquidation mode, while every financial headline screamed total meltdown, I pulled the Shanghai Gold Exchange data. Shanghai spot silver price, 94 or 95. Let that number settle. Western silver was trading at $78.88. Shanghai silver was at 94.4 or 95. That is a 16.07 gap per ounce, a 20.4% premium. The same metal, same element, same molecular structure, 2 completely different prices separated by the Pacific Ocean. And the side everyone assumed was panicking the hardest, China, was paying 20% more for it. Why would sophisticated institutional buyers pay 20% above market price unless the market price is fundamentally disconnected from reality? Unless Western paper pricing is artificial and Shanghai physical pricing reflects actual scarcity? Think about what that premium is screaming. But the story gets more extreme, and what I found when I went deeper into the data might be the single most important chart in all of commodities right now. I traced the Shanghai Premium backwards over 12 months, not the absolute price of silver, just the premium, the gap between what Shanghai pays versus what the West pays. That gap has expanded by 1,874% in 1 year. Read that number again, 1,874% premium growth. That is not a market experiencing normal price discovery. That is a market where two completely separate realities are diverging at an accelerating rate. Now here's the second thing nobody's reporting. And this one is equally insane. On the Shanghai Futures Exchange, every single silver contract hit limit down. Every maturity, every expiration. February contract locked at minus 20%, March contract locked at minus 20%, April contract locked at minus 20%, all the way down the curve. Trading halted. Circuit breakers triggered across the board. You could not trade even if you had wanted to, but convert those limit down prices into US dollars. The Shanghai Futures Exchange. February contract at absolute limit down was 97 months. Western futures at the same moment were trading freely at $78.88. China's worst case floor scenario was $16 higher than where the West was openly transacting. Their floor is our ceiling. Let that sink in. And China did not just passively watch this unfold. They intervened with overwhelming force. 5 commodity funds completely suspended from trading. Not restricted, fully suspended. The UBS SDIC Silver Futures Fund was shut down for the second time in 12 days. 16 individual traders were banned from opening new positions or withdrawing money for an entire month. Position limits were slashed across the board. They deployed every tool available to cool this market down. And yet, after all of that intervention, after all of that forced selling, after margin hikes and trading halts and fund suspensions, silver bounced from $72 back to $85. The floor held. Physical demand absorbed every single ounce being panic sold. Remember that detail because it becomes critical in a few minutes. Now here's the question that kept me awake for 2 nights straight. The Shanghai Exchange had already started tightening rules on January 27th, 3 full days before the crash. They widened price limits, raised margin requirements, reduced position sizes. They were preparing. If Shanghai saw this coming days in advance, who else knew? And that brings me to the third piece of evidence. This is the one I saved until right now because you needed to see everything else first to understand why this matters so much. JP Morgan, the largest bank in America, one of the most powerful precious metals traders on the planet, recently moved their entire gold trading desk to Singapore. Not expanded, moved from New York to Singapore, right into the heart of Asia. Right where physical demand is exploding. Right where Shanghai's premium signals true scarcity. They didn't relocate a satellite office. They moved the entire operation, traders, infrastructure, decision-making authority, from the financial capital of the West to the physical demand epicenter of the East. Why would the most sophisticated precious metals desk on Earth abandon New York unless they see the future of this market shifting fundamentally eastward? Unless they know something about where real price discovery is actually happening? Now layer that move on top of everything else we've already covered. Shanghai paying 20% premiums during a Western collapse, Chinese exchanges preparing days in advance, physical buyers absorbing every ounce of panic selling, JP Morgan repositioning to Singapore right as this divergence accelerates. This is not coincidence. This is strategic positioning ahead of a structural shift in how precious metals are priced globally. For decades, the price of gold and silver has been set in London and New York. Paper contracts on COMEX and the LBMA determined what billions of ounces were worth. Even though those exchanges settle less than 1% of contracts in actual physical metal, it's a paper market dictating the value of a physical asset. But what happens when the largest buyer in the world stops accepting that paper price? What happens when China, India, and the broader Asian bloc say, we will pay what physical metal is actually worth in our market, not what your leveraged futures say it should be? You get a 20% premium. You get circuit breakers, you get JP Morgan moving east. You get 2 parallel realities that cannot coexist indefinitely. One of them has to break. Either Western paper prices rise to meet Eastern physical demand, or the paper market loses all credibility and relevance entirely. The Chinese are betting on the latter, and they are not just betting, they are actively accelerating it. Let me show you how. During the crash, while silver was in free fall across every Western exchange, Shanghai physical deliveries did not slow down. They increased. Chinese buyers were not running away from silver at $75. They were running toward it. treating every margin call, every forced liquidation in New York and London as a discount opportunity to accumulate real metal at artificially suppressed prices. This is not panic. This is predatory accumulation. And it is not just silver. Gold showed the same pattern. While Western funds were dumping, Eastern central banks and institutions were buying. The People's Bank of China has been a net buyer of gold for 15 consecutive months. They are not trading. They are accumulating strategic reserves because they understand something most Western investors have forgotten. Gold and silver are not just commodities. They are monetary metals. They are insurance against currency debasement. They are geopolitical leverage. And if you control the physical supply while your adversaries are stuck trading paper contracts, you control the market. China has been preparing for this moment for over a decade. They have built the Shanghai Gold Exchange into the largest physical bullion market on the planet. They have eliminated export restrictions, making it easier to pull metal into China than push it out. They have created a closed-loop system where Western sellers provide inventory and Eastern buyers accumulate it permanently. It is a one-way valve. Metal flows east. It does not flow back. Now think about what that means during a crash like we just witnessed. Every ounce liquidated by a panicking hedge fund in New York becomes an ounce delivered to a patient sovereign buyer in Shanghai. Every margin call in London becomes a transfer of physical wealth from west to east. The crash was not destruction, it was redistribution, and the evidence is sitting right there in the premium data. If there was genuine oversupply, if sellers were truly overwhelming buyers, the Shanghai Premium would have collapsed. It would have gone negative. Instead, it exploded. Because the physical market and the paper market are telling two completely different stories. Paper said, "There's too much silver, sell everything, the price must fall." Physical said, "There's not enough silver, we will pay 20% over your paper price to secure real metal." Who do you believe? The algorithm-driven futures exchange where 100 contracts chase one real bar? Or the buyer writing checks for actual delivery? Western media covered this crash as a speculative bubble popping, overheated traders getting liquidated, a return to normalcy. But if you look at the data from the Eastern perspective, this was not a bubble popping. This was a fire sale. And sovereign buyers showed up with cash. Now here is where it gets even more interesting. The US government noticed. I am not speculating. There are reports, credible, sourced reports, that emergency meetings were convened at the highest levels of the Treasury Department and Federal Reserve in the days following the crash. Why? Because a 40% collapse in silver and a 15% freefall in gold in 72 hours does not just hurt speculators. It destabilizes commodity markets. It triggers contagion risks across derivatives. It exposes the fragility of leveraged financial systems built on paper contracts that cannot be honored in physical delivery. And it sends a very clear geopolitical signal. The West is losing control of commodity pricing. If Chinese buyers can pay 20% premiums during a crash and still clear the market, what happens when the crash ends? What happens when the next rally begins? And Western institutions realize the physical metal they thought they could access is already locked in Shanghai vaults. What happens when COMEX traders demand delivery and there's not enough inventory to satisfy contracts? You get a short squeeze, not in price, in metal itself. And that is the nightmare scenario keeping central bankers awake at night. Because here is what a physical short squeeze looks like in precious metals. It does not start with a price spike. It starts with delivery delays. Your metal is coming, just wait 2 more weeks. Then 4 weeks, then 8. Then exchanges start offering cash settlement instead of physical delivery. We will pay you the contract value plus a premium. Just don't ask for the actual bars. Then premiums explode, not 20%, not 50%. We are talking triple-digit premiums as buyers desperately chase scarce physical inventory. Then the paper market breaks entirely. Because once enough traders realize the contracts are not backed by real metal, confidence evaporates. The entire leverage structure collapses. And the entities holding physical metal, sovereign nations, central banks, long-term accumulators, they set the new price because they have what everyone else suddenly needs and cannot get. China is positioning for exactly that scenario. Look at their actions, not their words. They are not buying silver and gold because they think the price will go up next quarter. They are buying because they believe the current pricing mechanism will fail. And when it does, whoever holds the physical metal holds the power. That is why the Shanghai Premium matters. That is why JP Morgan moved to Singapore. That is why emergency meetings happened in Washington. This crash was not the end of the precious metals bull market. It was a stress test, and the Western paper system failed while the Eastern physical system absorbed everything and held firm. Now we are in the rebound phase. Silver has bounced from $72 back to $85 and climbing. Gold has recovered from $4,120 to over $5,000. The forced liquidation is over. The weak hands have been shaken out. But the structural problem remains. There are still far more paper claims on silver and gold than there is actual metal to deliver. There is still a 20% premium in Shanghai signaling that physical scarcity is real. There are still central banks accumulating while hedge funds are trading. And there is still a fundamental divergence between what the West thinks these metals are worth and what the East is willing to pay. That divergence cannot last forever. One side will be proven right. One side will be proven catastrophically wrong. My analysis, based on flow data, premium spreads, sovereign accumulation patterns, and geopolitical positioning, tells me the East is right. Physical demand will eventually overwhelm paper supply. And when that happens, the price discovery mechanism will shift permanently from New York and London to Shanghai and Singapore. We are watching the early stages of a historic transition in how commodities are priced globally. Most people will not realize it happened until it is already over. Until they wake up one day and silver is $200, gold is $8,000, and there is no inventory available at any price in Western markets. The smart money is not waiting for that day. They are positioning now, while prices are still suppressed by paper selling, while physical metal is still accessible, while the divergence between East and West is still an opportunity rather than a crisis. JP Morgan is not moving to Singapore for better weather. China is not paying 20% premiums out of generosity. These are strategic moves by entities that see what is coming. The question is, do you? This crash gave you a gift. It gave you lower prices on an asset that sovereign nations are fighting to accumulate. It gave you a clear signal that the paper market is fragile and the physical market is strong. It gave you a moment to act before the next phase begins. Because the next phase will not be a crash. It will be a shortage, and shortages do not create buying opportunities. They create regret. If you found this analysis valuable, if it connected dots you have not seen anywhere else, if it changed how you see the headlines coming out about precious metals, do me a favor, hit that like button right now. It tells the algorithm that this content matters, that real analysis cuts through surface level narratives, and that people want to see the financial power moves happening behind closed doors. Subscribe to this channel if you have not already, because this is the only place you will get this level of depth on commodities, currencies, and the geopolitical chess game playing out in real time. I do not repeat mainstream talking points. I show you the data they are not showing you. Share this video with anyone who needs to understand what really happened during this crash. Send it to your trading groups. Post it in your investment forums. Because the people who see this coming early will be positioned correctly. The people who only hear the sanitized version will be caught off guard. And drop a comment below telling me, are you watching the Shanghai Premium? Are you paying attention to physical flows? Or are you still trusting the paper price? I want to hear your perspective. The precious metals market just went through the most violent shakeout in modern history. But the entities with the longest time horizons and the deepest pockets did not panic. They accumulated. That tells you everything you need to know about where this is headed. The floor held at $72. Physical demand absorbed the panic. The premium in Shanghai proved the scarcity is real. And now the rebound has begun. The only question left is, will you be positioned for what comes next?